Should you try dividend capture strategy for dividends? Imagine turning a quick profit from dividends without holding stocks long-term. Sounds tempting, right? But before jumping in, let's look at what this strategy really involves. The dividend capture strategy is a short-term approach where investors buy stocks just before the ex-dividend date to qualify for the dividend. Then they sell the stock shortly after, aiming to profit from the dividend payout without keeping the stock for the long run. It seems simple, but there are important things to consider. First, you need to understand how dividends work. To get the dividend, you must own the stock before the ex-dividend date. On that day, the stock price usually drops by about the same amount as the dividend. For example, if a stock pays a $1 dividend, its price might fall by roughly $1 on the ex-dividend date. If you buy at $50 and sell at $49 after the dividend, your profit is almost zero once you include transaction costs and taxes. One major challenge is price adjustment risk. Since the stock price drops by the dividend amount, any profit from the dividend can be wiped out. Plus, the stock might not recover quickly, especially in volatile markets. Then there are transaction costs. Buying and selling stocks frequently means paying brokerage fees, which can eat into small gains. Taxes are another factor. Short-term dividends are taxed at higher rates than long-term dividends, reducing your net returns. Timing is also tricky. You need to be precise about when to buy and sell, which can be hard to do consistently. This strategy is focused on quick gains, but it doesn't build wealth over time. Instead, it can lead to more risk and less stability. For adults looking for steady growth and income, long-term dividend investing usually makes more sense. Buying quality companies with a history of increasing dividends and holding onto those stocks can generate reliable income and potential stock price growth. Reinvesting dividends helps compound returns over time. In short, while the dividend capture strategy might seem appealing for quick money, it often isn't worth the effort or risk for most investors. A long-term approach of buying and holding dividend-paying stocks tends to be safer and more effective for building wealth.